Okay, trying to make sure I got this set up right. How you doing, everybody coming in? Trying to make sure I got this camera set up right so I can see what's going on. Ooh, okay. I think I got it. Okay. There we go. Okay, how's everybody doing? I'm Will, the credit guru. Thank you all for joining me tonight on this scope. Here to talk about getting your credit ready and your budget ready. How you doing? Oh, hey, how you doing, Sinetta? Anybody that's new to scope with me, you could go ahead and say hello, say your name, say where you're from, and make sure you tap the screen. Show some love with the heart so that I can know, show that so that I can see that you guys are here, see that you guys are enjoying the content. We're going to get started really soon. If any of you guys know somebody that could use this information, somebody that's trying to get a mortgage, get approved for a house sometime soon, and they will probably want to know how to, pay it off really fast. Everybody doesn't want to do a 30-year mortgage. It would be, to your benefit to do it in 15 years. Costs extra money, but at least you wouldn't be tied down for extra 30 years. But let me introduce myself so you guys know who I am. As I said already, I'm Will, the credit guru. Thanks, Connie, for joining. How you doing, Andrea? Turn the phone on. Oh, okay. How you doing? Lana from Atlanta. I think I said that right. Samantha from Atlanta. Okay. You guys are kind of close. I'm in Montgomery, Alabama, so we're not too far. Everybody, go ahead and share with your followers. If you're on Android, swipe up, and you can hit the share on Twitter, share it with your followers. And on Android, I think you swipe left. I'm sorry, on iPhone, you swipe left to right, and you can share with your followers. Also, if you're interested in getting more credit tips other than what we're going to be talking about today, make sure you swipe up and tap the Perry dude so that you can follow me and get some more credit tips in the future. Now, as I said, tonight we're going to be going over how to get your credit ready for a mortgage, and also how to pay it off within 15 years instead of having to pay for 30 years. So, I almost lost you. Now today I have a special guest with me. I have the financial hack, Andrea. If you don't mind, throw up some emojis or something like that so everybody can see you and everybody can follow you. Now, while I'm talking about the credit and budgeting tips today, what we're going to do is we're going to do something a little bit different. We're going to be going over some payments, potential payments. There she is. And you guys go ahead and follow her. She's really good about giving financial tips on budgeting, getting your, as she likes to say, she helps you whip your budget into shape, or whip your finances into shape. The financial hack. So you guys go ahead and you follow her at I am Coach Andrea. And tonight, while I go over the content, we're going to get some numbers from you guys as far as, hello, how you doing from Memphis? How you doing, Yolanda? We're going to be going over some mortgage payments. So we're going to get you guys an idea on what type of payments you will be looking like with a certain type of interest rate based off your credit score, and also how much you would have to pay and on a monthly basis to try and get your mortgage paid off in about 15 years. Now, if there's anybody in the room who is interested in getting a mortgage sometime soon, make sure you put a 1 in the comment box, just so that I can know that this is something that's for you. So if you're trying to get a mortgage sometime soon, or if you have one and you want to, you're trying to pay it off a little bit faster, go ahead and put a 1 in the comment box. And make sure you guys are tapping those hearts too. Okay, I see we got at least one person, 2. Okay. So we got a few people, 3. All right. So we got a few people that are in here that are going to be interested in this content tonight. So we got some good stuff for y'all. So let's go ahead and get into it. So basically, the first thing I was going to let you guys know is the best thing you can do when you're getting started with this process is you need to go ahead and check your credit score. That's the best thing that you can do. Now, I know some of you may want to go ahead and go to the mortgage place and have them pull your credit first, but it would be much better for you if you prepare yourself before you even go in the door. And a lot of what I'm going to tell you is going to get you ready. Hey, how you doing? I think Nikki. So what you want to do, like I said, is go ahead and get your credit reports. Now, there's plenty of different places you can get your credit reports. You want to make sure you can see your scores, and you want to make sure you can see your reports. Now, a lot of people, they use Credit Karma. That's okay, but what you really want to do is you probably want to get something that'll show you all three. Because when you go to the mortgage lender, when they try and pull your score, what they're going to do is they're going to look at whatever score is the highest. You said, should they get all three? Yes, they should get all three. And the reason for that, do start off with the hard increase. Okay. The reason why you want to get all three is because the mortgage lender, when they look at your credit, you're going to have three scores, all three credit bureaus. Whatever score is the highest, they're going to drop that one. They're not going to look at that. Whichever score is the lowest, they're going to drop that. They're not going to look at that. They're going to look at whatever score is in the middle. So if you use Credit Karma, you can only see Equifax and TransUnion. So you'll only see two. So you don't know what the other score is. So that means that you're not going to be prepared when you go in there, because the other score could be extremely low. It could be extremely high. You won't know. That's why it's important to get all three before you go into the office. Now, there are a bunch of different credit monitoring services out there that you can use to get all three of them. Someone may want to know. Oh, yeah, you're right. You're right. What was the question that you had? I may have missed it. What are the scores different for each bureau? Yes, every credit bureau, the credit bureaus do not work with each other. Even though they do the same thing, they don't work each other. They're all three separate companies. So they have different information on each credit report, which is another reason why you want to see your credit reports. Because you may have an account, let's say with Wells Fargo, for example, and on Wells Fargo may only report to 2 out of the 3. So that third one, it may not be there. So your score is possible. It's possible for it to be different. Okay. Yeah, it's possible for it to be different on that third credit bureau, but you won't know that if you can't see all three. And another thing, you might have an account that's on all three, but one account may show that you've paid off the account. The other account may show that you still owe money. That's why you have to always look at all three to get the better picture. But yeah, just make sure you find a way to get all three. If you get the free annual credit reports, you don't get your scores, you only get the reports. So that's not going to really help either, because you need to see what your scores are. Now, the next thing that you're going to need to know, your scores, most places can get you approved if you have a middle score of a 620. But you want to make sure that what the scores that you are seeing, or you have at least 2 of them at 640. And the reason why I say that is because lenders, they can approve you with 620, but they would like you, it's better for them and for you if you have a 640. Now, everywhere that you get your credit score from, they normally use a different scoring model. And what that means is it's different ways that they grade you points to give you a score. So when you go to this bank, they have a different scoring model. They have a different version of FICO. Your lenders, they have the FICO system, so they're going to be pulling your FICO scores. Anything you get yourself isn't going to be a FICO score. It's normally going to be a Vantage score, which is a credit score that the credit bureau's made up. So it's either that score or a different type of score. It's more than 55 different versions of a credit score out there. So every way you look at it, even on Credit Karma, is going to be different by the time you get to the lender. Sometimes it can be above what you have seen, or it can be below what you've seen. So the reason why you want it to be at a 640 is because, like I said, the threshold to get approved is 620. So if you look at your score and you see it's at least a 640 somewhere, by the time, yeah, it's 55 different versions. But if you have a 640 wherever you're looking at it at, by the time you get to the lender, at least you know that if it was lower, that you'll still meet the threshold. Because if you saw a 620 on Credit Karma, and then you go to the lender, it may be a 615, and then you have to go and do some work to build your score up. So it's no, it's not 2. It's a bunch of different versions. The way that it works, FICO, you have a different score for everything that you apply for. You have a score for a mortgage, you have a score for a credit card, a car, anything that's a different form of credit, you have a score for it. And besides that, just like Windows updates every few years, and we have a choice on if we want to update our computer with the new software, they have a different version of FICO that comes out every few years. And the lender has a choice if they want to upgrade their software to use the new version of FICO. So everybody doesn't always upgrade, so people have different systems, plus you have a different score for each item you applied for. So your score is going to always be different. That's why you never see the same score in 2 different places. So the important thing is going to be what your score is at the lender that you're going to go to. That's the important thing. So Thank you, thank you. So that's why you want to find your credit score wherever you can, find all three. And besides finding all three of your credit scores, you want to make sure that at least two of your scores are above 640 wherever you find them at, so that you'll have a little bit of leeway by the time you get to the lender. What's next? And also, lenders, while you're going through the home buying process, they're going to be doing a lot of inquiries on your credit report. So they keep checking your credit to see if it's the same at certain at certain points in the process. So that's why you want to make sure that your score is as high as it can be, because you know each inquiry is going to drop your score a little bit. So the higher it is when you go into it, the safer you'll be by the time you get to closing, because you don't want your score to drop under what you need by the time you get to closing. And the process can take sometimes 30 to 45 days. And again, you guys tap the screen and let me know if you know this is valuable information to you, and if you're really enjoying what I'm talking about, if you're learning something, and make sure you share with your followers to get them in here so that they can learn the rest of this information too. So going on to the next part, we're going to talk about the accounts that are on your credit report. So these are what your accounts on your report need to look like for most lenders. Now, everything that I'm going to tell you at this point is going to be based on a lender that I work with here in Alabama for most of my customers that I send. Now, if you didn't know, I have a credit repair company that I run here in Montgomery, Alabama. I help people repair their credit. And I also have a second company, 850 Mindset. Over there, you can go and you can learn how to repair your credit yourself. So if you don't want somebody to do it for you, you can go to 850mindset.com and learn how to do a lot of this stuff yourself that I do for customers. But anyway, back to the content. The accounts on your credit report. You can have whatever score you need. You can have your 640, you can have a 700 score. If you have the wrong, that's right, 850mindset.com. Also, the link is in my bio, and you can get straight to my 850 club where you can sign up to learn how to repair your credit yourself. But there's a lot of free information teaching you about credit on the site too. But the accounts on your credit report, it doesn't matter if you have the score that you need, if you have above the score that you need. If you have certain things on the account section of your credit report, they'll still decline you. So the score, everybody's always worried about the score, but it's other factors that determine you getting approved. So with accounts, you don't want to have any bad debt on your credit report of more than $2,000. And like I said, I use these guidelines based off of Right. You need to clear it up first. I use these guidelines based off the lender that I use out here in Montgomery, but they have this is going to kind of be somewhat general for what most people are going to look for when you're trying to get approved. No matter where you are, this is going to be some general information I'm going to try to get to you. So you need to owe less than $2,000. So if you have collection accounts, you got a bunch of them. If they total less than $2,000, you'll stand a good chance of still getting approved. Now, this doesn't count for your medical bills. A lot of the new lending rules allows them to overlook medical bills. So the medical bills, you wouldn't count that in the 2,000, but anything else that you have that you owe, if you have any charge-offs that still show that you owe money, or you have collection accounts that show that you owe money, those are the type of accounts that I'm talking about. So you need to make sure that you don't owe no more than 2,000 in collections by the time, in bad debt, by the time you're trying to get approved, because that's going to slow you down. And I said the medical don't count. You also don't want to have any late payments on your credit report within the last 24 months. For student loans, if your student loans are charged off. Now, I don't mean like, on a credit card, active student loans, no, that's a different part that I'm going to get to next. I'm talking about bad debt, like you owed somebody money, you didn't pay them their money, and then they're putting it on your credit report that you owe them. If you just have like debt from a credit card that you have a balance on, that's a different part. That's not this part that I'm talking about right now. But yeah, you don't want to have any late payments on your credit report within the last 24 months. Is sometimes some lenders can approve you if you don't have any within the last year, but you're going to need to have a lot of other good factors on your credit report in order for them to overlook late payments. In order to overlook late payments within the last year. So make sure that you don't pay anything late in the coming years before you're about to try and get a house, because it can really mess you up. In those late payments, if you've paid everything on time, everything on your credit report on time for however many years, if you get one 30-day late payment on your credit report, it can drop your score 50 to 100 points just from one late payment. So don't do it. That's the easiest way I can put it. Don't do it. Make sure you pay anything that's a loan, a credit card on time, so that you don't have to worry about that. Right, that's right, it does. In the next thing, what is it? Public records. Any public records on your credit report, that would be a tax lien, a bankruptcy, a judgment where somebody you owed money to went to garnish you. It needs to show on your credit report. Yeah, it's a lot of this stuff most people don't really know. Nobody really tells us this stuff, but that's why I'm here to tell you about it. But public records, any of those public records, they all need to show that they are satisfied on your credit report. If they don't show that they're satisfied, oh, you're welcome. If it doesn't show that they're satisfied, then you need to have paperwork proving that they're satisfied, because the lender is going to want to see. It's all about the lender seeing that you don't owe a whole bunch of people money, because if you owe a whole bunch of people money, they're going to be worried about how you're going to pay them back their mortgage payment after they lend you all that money. So they want to make sure that you don't owe too many other people a whole lot of money. But yeah, public records, you need to make sure that they show that they're satisfied on your credit report. A lot of times when you pay those things off, when you pay off collections and stuff like that, they still show on your credit report that you owe them money, or they'll still show unsatisfied on your credit report with these public records. You really have to keep up with it, and most people just assume that it's going to be updated on their credit reports, and normally that's not what happens, because once they get their money, they kind of don't care anymore. You know, it's kind of on you. They really don't care at that point. So it's up to you to make sure that everything on your credit report is right. And you can't know that if you don't check it. That's the very first thing that I mentioned. So that's why you got to make sure you stay on top of your credit, so that when you're trying to do things and make moves, you don't have to try and get this stuff cleared up and slow you up from whatever it is that you're trying to get done. Now, with any of these things on your credit report, that's right. Get it in writing. You have to have something in writing to show proof, because people don't want to hear your word of mouth. They want to know that it's truly taken care of. Does that apply to debt? Yes, judgments and everything that can apply towards that $2,000 in debt. It can. Hey, how you doing, Laura? Good to see you in the scope. But yeah, your public records are going to be. You need to make sure you get those taken care of. Now, with all of these different pieces of information, like collection accounts, judgments, medical bills, all of that stuff, debt on your credit report. A lot of people think that that's stuff that you can't get taken off your credit report, and I'm going to tell you exactly how credit repair works. Basically, all you need to know is that there are laws. The laws say that it doesn't matter if something is yours or not. It has to be 100% accurate on your credit report. And I just told you, sometimes they have things on your credit report that don't show up accurately. And if you can prove that it's inaccurate, they can take it off your credit report. So a lot of people come to me and they think that stuff can't come off because it belongs to them. The law, it's not about what I say, it's about what the law says. The law says that if it's inaccurate, they have to take it off your credit report. And you can learn about all that stuff that I just said on how to get some of that stuff cleared up on your credit report. If you're trying to get approved for a mortgage or something like that in the future, you can get all that information on 850mindset.com. Like I said, the link is in my bio. You can go ahead and go there, and you can try and start learning how you can clean up your credit yourself. You know, so you can join the 850 Club. That's where you learn exactly how to fix your credit yourself if you need to do that, if you need to indeed do that. But they have a lot of free information. Like I said, you can go and just learn. Thank you guys. That's it right there. Now, next part is going to deal with your budget as far as getting, got to get your house in order. But the next part is going to deal with your budget. And basically it's going to deal with your debt to income ratio. So, that's also something that can stop you from getting approved. If you have your credit in line, your credit score is where it needs to be, your accounts all look good, your debt to income ratio, that can mess you up too. It's two different parts that they look at. The first part that they're going to look at is how much the potential housing payment, the potential mortgage payment that you're going to have, that's your mortgage, including the loan payment, your insurance, your taxes, all of that stuff included in the payment. That's what they're going to look at. They're going to calculate that total, and they're going to see how much of that mortgage payment is going to take up of your current income, your gross income, so before taxes. So what they're going to do is, let's say you make $2,000 a month gross, and you have a mortgage, or the potential mortgage payment is going to be $700. Now that would equal up when you divide 700 by the 2,000. That's going to give you 35%, and that is separate. That's called the housing ratio, because they just want to see how much that mortgage payment is going to take up out of your your income. And typically, most places don't want you to have that number too high, because at that point they still haven't included in your other expenses. That's where your debt to income comes in. So this is just a housing ratio, just to see how much the mortgage payment itself is going to take out of your income. Now, when your debt to income ratio comes up, that's when they're going to look at the mortgage payment, and then they're going to include any loans or credit that you currently have that show a payment on your credit report. Now, your car note, your credit card payments that show up on there, any personal loans that you have, all those payments are going to be included in the debt to income ratio. And they also now they include your student loan payments. Even if they're deferred now, they have to include whatever the payment says on your credit report, and normally that's pretty high. So they just take all the numbers that they see and they total it up. The only other way to keep them from doing that, because that can really raise your debt to income ratio really high, is for you to you have to have consolidated your student loans and be paying on them. Yeah, it's not, because it used to be a lot easier to get approved with the student loans. If your car's age, pay for the lenders will stretch the DTI a little. Right. That'll stretch it out because it'll lower the payment. But you definitely need to make sure that before you go in to try and get the mortgage, that you've paid down your credit card so that payment doesn't affect you. And if you have student loans, at this point, with this new rule, you're going to have to make sure that they're at least consolidated if you have a whole bunch of them, before you can get approved, because it might tear up your debt to income ratio. Oh, you good. So basically, like I said, you want to make sure that your debt to income ratio, what a good debt to income ratio looks like. The lender that I use, they do about 45%. So the new mortgage payment, including your current expenses, all together should only be about 45% of your income. Now, they have a lot of places. Most lenders are going to want you to have like 36%. That's including whatever this new loan is going to be like. If you're trying to get a car, like when I used to work at Wells Fargo, it was 36%. No, I'm not a lender. I used to work for Wells Fargo for 3 years, so I have to look at all of that. But I just help people with their credit, a little bit of the financial stuff, and I just help them get to a lender so that they can get approved. I am doing real estate now, though. I'm taking a class right now. I actually just came from the class, but not doing that yet fully. But right now, yes, we will. And yes, 36% that's a key number to remember. If you can keep all your debt to 36%, you'll pretty much be good wherever you need to go. And it needs to be 36%, remember, including whatever this new payment is going to be. So you need to be lower than that before you get there. But like I said, they have some lenders, they'll let you do 45% debt to income. So just keep that in mind. You have to try and see what your number is before you go into the lender, so that you can know that you won't get declined for that. So you need to make sure that your score is good. Do they use your gross or net? I believe they're going to use your profit, Connie. I think, because most of the lenders that I know, I think if you're self-employed, they're going to look at whatever your profit is left over for the month. I hadn't asked that in detail, but I will try and find that out. But more than likely, that's what it's going to be. Whatever your net profit is, they're going to go off that, because they're going to go off gross after whatever is left over from the business. That's all gross to you, as the business owner. But I think that's what it's going to be. So compare all of your payments. Now, don't include your car. Several first-time programs higher than 30%. Yes, that's right. Because they try and give you some leeway. But you don't want to put yourself. Now, they do have some places that'll approve you up to 50% DTI, but you don't want to put yourself in that kind of situation, because if you overextend your income yourself, you could end up foreclosing on the mortgage for not having money to pay it. Yeah, that's a good number to go by. 41% is good. Tax returns, my gross was used. Yep, that's right. And another thing, a lot of lenders, if you have some bad factors on your credit report, they might want to see that you have a reserve. And what a reserve is, they want to see that you have at least a few months no more than 3 really would be needed. They want to see that you have at least 3 months of what your mortgage payment would be saved up in your savings or in your checking account. And normally they're not going to ask you for that unless, like I said, you have some bad factors. Like say you have some late payments that are within the last 12 months. Then they might start asking you for some stuff like that. But just try and make sure that you have something saved up anyway, just in case you need it. Gifting, now I don't know about that in detail. So I'm not even gonna lie to you on that one. But I'm gonna find out some more about that as well. And another thing, if you also have some bad things on your credit report that you may not be able to, handle or tackle, yes, you guys give some hearts. Like I said, go ahead. Let me know y'all alive. Let me know y'all still there. Go ahead and tap the screen and share with your followers if you still have anybody that might need this information. And share on Twitter. But you might want to have some rent history. So some rent history would be you paying anybody that you're renting from in checks, so that you can have some type of rental history. With your apartment complexes, normally you do the same thing. So you got to have a history that you pay rent on time, because that's going to help you with the approval process if you have a few bad things on there. To show gifting would be to show longevity of income for it to count. Right. Okay. And thank you for that, because like I said, I didn't know too much about that. And now, for all you guys that were interested in trying to get a mortgage, I want you guys, we're going to do some calculations now. So we're going to try and see what your payments would look like. So I want somebody that was interested in getting a mortgage to go ahead and throw a home value out there. If you're looking to get a house within, 100,000, 200,000, 150,000, throw out a number that you would want, the range that you would want for a house. And then we're going to calculate the calculate a payment. 200,000. Okay. The first one was 200,000. So we're going to go with that. I'll ask you guys again. Well, as a matter of fact, let me just write some of these down. 200. Got 125 there. Let me see what else we got. 200, 125. And I guess we'll go with 150. So now we're going to get some calculations going. Andrea, let's go with the $200,000 house. So we got somebody who wants a $200,000 house. And we're going to go with 200,000 for right now. And we're going to say that they have good credit. So their interest rate is going to be 3%. And we're going to come to some other numbers, you guys, in a second. But we're going to go with the 200,000 since that was the first one that popped up. So they got a 2%, and we're going to do the 30-year mortgage first, just so they can see that. So $200,000 house, 3% interest rate because they have good credit, and 30-year mortgage. And we're just going to wait a second for Andrea to calculate that up on her nifty calculator, her financial calculator, so we can see what that monthly payment will look like. And you guys go ahead and tap the screen. So the payment on a $200,000 house with good credit is $843.21 for 30 years. Now, let's say that this person's credit was not so good, and they got let's say they got a 6% interest rate. Yeah, oh yeah, and it's principal and interest only. This isn't including, your taxes and insurance and all of that good stuff. This is just including what you would pay for principal and interest, basic mortgage. But yeah, Andrea, let's do the same calculation, but bad credit, 6% interest rate. So double the interest rate based on the credit history. So we're gonna see how much this bad credit is going to affect this $200,000 house, so that you can see how much extra it's going to cost you. And the thing about a mortgage, you really want to make sure that your credit is in line before you get this, because as we said, oh my, that hurt my heart when I looked at that. Let me see, that's about, that's almost $400 more, a little bit less than that, but yeah, so for bad credit, you're going to pay $400 more a month for 30 years. The $400 more every month for 30 years because you didn't work on your credit before you did it. Yeah, and that's a lot of money. It's a lot more that you can do with $400 a month. So now, same $200 house. Now we're gonna do still the good credit payment. So we got good credit. We took care of business before we got in the door. We cleaned up house. So let's see how much you would need to pay it off in 15 years. That same $200,000 mortgage at 3%. And we're gonna wait a second for her. You guys go ahead and tap that screen. Go ahead and tap, tap, tap. Get a drum roll going on the screen, while we wait on that answer. And are any of you guys homeowners now? How do they base it on couples? Okay, with couples, what they do, when you apply for the mortgage, you basically they're gonna treat both of you guys like you're separate people applying. And by that I mean both of you guys are gonna have to meet with the credit standards, is what I mean. In the process, okay, so Love it 816, you're in the process of getting home, not a homeowner yet. Okay, so 1381. But just to finish answering that question, yeah, they're going to treat everybody like they're separate. So both people are going to have to meet all of those credit qualifications. Now, with the debt to income ratio, it's going to really help you with that because you're going to have a lot more income. But as long as the other person doesn't have a whole lot of expenses. So they make both of you guys qualify the same as if you were applying a loan. That's how they treat a couple. So 15 years on a mortgage for this $200,000 house. The payment is $1,381 a month. Now, you could make 2 payments a month. That $843 was the regular payment. You can make, 2 payments a month, making sure that second payment is going towards the principal, because you want to make sure it's going towards the principal so that you're not paying an interest. Because at the beginning of your mortgage, most of your payment is going towards the interest. So you're not really going to knock down the balance too high too early, unless you make sure that extra payment is going towards interest. But paying about almost $1,400 a month would help you pay that mortgage off in 15 years. So with bad credit, you were paying $1,200 a month, and you were going to pay that for 30 years. But you can pay a little bit less than $200 more than that bad credit payment and be done in 15 years on the same house. So your credit is going to really make a difference in what you get in the house and how quickly you can pay it off, because I would much rather, pay that amount to know that I'm going to be done in 15 years and half the time, because 30 years, that's like a prison sentence. That's a long time. But now we're going to go over to another payment. I think I saw $150,000. So now let's do same thing. No, let's go a little bit lower. 125. We're gonna do $125,000 house, because that's close to the range of the average house, I think. So $125,000 house, and it's going to have the same. It's going to have 4% interest. So not as good credit as before, but just a little bit lower, but still not too bad of an interest rate. So we're going to do 4% at 30 years and see how much that is for the $125,000 house. And you guys keep tapping that screen. Y'all still there? Y'all still there? Okay. I see the hearts now. I see the hearts. Y'all give me life with the hearts now. And we're going to see what kind of payment. Okay, now that's a nice payment. $596, so almost about $600 for the 30-year payment on that house. And let's see. Now with the bad credit, again, principal and interest only. Now with the bad credit on this house, we did 6% before. Let's see. Let's do 7%. Yeah, gotta make it know, because your payments will be higher once they add in the insurance and taxes. So that'll be some extra things that you'll have to pay, and that's some extra stuff you'll have to account for. But right now we're gonna see what the bad credit payment, 7% interest, is gonna look like for the 7 years. And I hope you guys are really enjoying this information. it was news to me when I heard about this. Yeah, 30 years, just to change in the interest rate, 7% interest rate. And do you guys have any other questions that I didn't cover so far, as far as the credit and the budgeting, saving up for your first mortgage? You guys have any questions on that? Go ahead and drop those in the comments. Oh, 831. I'm sorry. So again, about another $300 something that you're paying extra just for bad credit on the house. Extra $300 that could have went in your pocket to do something else. Well, to help you pay off the mortgage a lot faster. So we're gonna go back and do the 15-year mortgage on that $125,000 house. 15-year mortgage, and back again at that at the 4% interest rate. And these interest rates are all based off your credit. So whatever your credit is looking like when you walk in the door, that's going to determine what your interest rate is going to be. Your income is going to determine how much house you can get. But yeah, your credit is going to determine what your interest rate is going to be, and that's really, really important. So 924, so about 925. So again, for a little bit more than what bad credit will cost you, the bad credit payment for 30 years, $831. Good credit and paying it off in 15 years is a little bit less than $100 more a month on this $125,000 house. So that's real, that's real reasonable compared to having to pay again for 30 years. You can pay 15 years for the same amount you would have paid with bad credit. So basically, the moral of the story here is you want to make sure that your credit is right so that you can pay off your mortgage in 15 years at a reasonable price. Because if you try to go into a mortgage with bad credit and you still want to pay it off in 15 years, you're going to be paying a lot of money. It's going to cost you way more than somebody else. You'll end up spending hundreds of thousands of dollars more than somebody else for the same house just because of your credit. So yeah, make sure that you get your credit straight. And just to go over what I covered today and summarize everything, you want to make sure that your credit scores. Really? Okay. You want to make sure that your credit scores are at least 640 on 2 of your credit scores, to make sure that by the time you get to the lender, whether it's a little bit higher or a little bit lower, you're still going to be probably in a good range, because they're going to look at the middle score. So find all 3 of your scores. Make sure you do whatever you need to do to get at least 2 of them up to 640, and then you should be good to go as far as trying to get past the score part. As far as your accounts go, on the credit report, you want to make sure that you don't owe any bad debt of $2,000 or more. That does not include your medical payments or medical collections. And you also want to make sure that you don't have any late payments within the last 24 months showing up on your credit report. It is possible to get still get approved if you have some within the last 12 months, but it's going to be a lot harder. There's going to be more stipulations. You're going to have to put higher down payment down. The amount you pay over the life of the loan really illustrates the difference between 15 years versus 30 years. Yes, it does. Because you can, it won't cost you too much more, and it can save you a lot more time, especially if you can't afford to make the extra payment. And another thing that I saw on your scope that you said, Andrea, you don't want to go into the mortgage applying for a 15-year mortgage. It's better to apply for a 30-year mortgage and then pay it in 15 years, because the payment is going to be a whole lot higher on a 15-year mortgage if you sign up for that, and then you're going to be obligated to make that payment. Yes, please. But you're going to be obligated to how a medical collection viewed. They totally rule them out as long as you don't have a whole bunch of them. Like if you have medical debt that's stacked up above $2,000, then they'll start looking at it, because then that's going to be too much. But they just don't view it at all. They just rule it out, because with mortgages, it's certain things that they can rule out while they're trying to get you approved. Now, I'm not saying that stuff isn't affecting your credit, because things that affect your credit can sometimes be a little bit different from what the mortgage lender needs, because I have some clients that it's stuff that they need off their report to help their score, but the mortgage lender can get them approved, even though it's there, like the medical bills, for instance. So yeah, you just want to make sure that you know. Doesn't it lower your score? Yes, it does. But in some cases, you can have some bad stuff on your credit report, and your score may still be high. In some cases, it depends on the situation. But if that's why I was saying it's different what'll help your score compared to what the mortgage lender needs to get you approved. If your score is already there and you have only medical bills, you can probably still get approved. But if they got removed, your score will probably be higher because they got removed. A good consolidation to use, you're talking about student loans, right? 125K home, 227 total. That's the total that it would be after you've made all your payments. That's your principal with interest paid over the 15 years. Okay, yeah. So at 4%, 15 years. Yeah, and that's and that's not a bad amount to have paid, because you really would have paid a lot more interest than what she just showed had you paid it for 30 years. Because like I said, all of the interest is on those first payments that you're making at the beginning of the time of your mortgage. So you're paying a lot in interest if you only making the regular payments that they have scheduled for you to pay through the amortization. So it's really good. You save a lot of money by paying your mortgage off early and making those extra payments. And yeah, see, that's almost double what she just showed. That's almost double. Just by not taking the extra effort to make some extra payments. Yeah, it can cost you a lot of money. That 30-year time frame is no joke as far as costs go. So just come in. Hello, how you doing? Good to see you. I can't really see what the name is. I think it's, I'll just say Junior because I saw that part. But thank you. Welcome to the scope. We're getting close to the end of it, but you can catch the replay. And that's with a good interest rate, right? So even with the good interest rate, good credit, good interest rate, you can still pay a whole lot more money by paying it over 30 years. Meeting with NACA next week, preparing for a 15-year mortgage. Okay, that's good. That's good. So I hope you make sure you catch everything that you missed, because I want to make sure that you know some of this information while you're going through the process. And hopefully, I hope you get it done in 15 years too, so you can save all this money that we're talking about. Because I know it's other things that you people would rather do with all of that money that you could be saving. No problem, no problem. But again, let's see, 7%, $1 million on a 30-year. Oh, that's the bad credit loan. Whew. $1 million for a house. Do you know what kind of house you can get for $1 million? In Alabama, you can really get a good house for $1 million. And that's the amount that you pay for having good credit. What was the original amount of that loan that's $1 million? Was that the $200,000 house? Over 30 years? And you guys go ahead and tap that screen. Let me get a drum roll going with the hearts on 125K. Wow. That's a lot of money. Okay. You pushing for 1.75. Yeah. Now you gotta have a really good deal going with your credit too, to get that low of interest rate. The average interest rate right now that a lot of people are getting that are for a good rate is 3.75. So to get something that low, that would be pretty good. But the average rate that most people are getting, you said no credit. Oh, okay. But most people with decent credit scores, like I said, around a 620, 640, they're getting around 3.75. Maybe a little bit better than that if you just have really pristine, credit score or whatnot. But let me go back to summarizing everything else that we covered today. I did mention the no late payments within the last 24 months. If you have good credit and score, should you consider refinancing after a year? If you got the mortgage, no, I'm not in Chicago. I'm in Alabama, in Montgomery, Alabama. And no, I don't own a home yet, but that's going to be something that's going to be the next thing that I do. Hopefully I get to own more than one, but that's going to be the next thing that I do. I forgot what question I was answering. Who was just asking me a question? I forgot what the question was just that fast. Um, FHA loan. How soon? Oh, refinancing. How soon can you refinance a conventional? Hold on a second. Let me finish that refinancing question. With the refinancing, if you want to, if your credit score was bad when you first got the mortgage, then you would want to refinance. If you know that you just have a high interest rate, you would probably want to refinance after a year if you can, so that you can try and save money, because it wouldn't, if you have improved credit compared to what you had when you first got it, then it'll benefit you to save that money, because you're going to have it for a long time. Hopefully you'll have it for 15 years, but you want to refinance so that you can start saving as soon as possible, because you can do other things with that money. So yes, after about a year, I'll probably look to refinance if you've made improvements on your credit. So it's going to take some some activity, some proactivity on your end to make sure that you are good, to get a better interest rate. Otherwise, you're still going to be stuck with pretty much the same situation. What was another question you guys had? So you wouldn't be able to do help in Chicago. Oh, the credit repair laws go by state. So each state has different requirements for a credit repair company. Now, I have what's needed to operate in Alabama, Michigan, and New York. So those are the 3 states that I can operate in. But because I can't operate in every state, that's why I have 850mindset.com. And I know you came in kind of late. You may not have heard that part, but at 850mindset.com, the link is also in my bio. I have nothing but credit education there. You can learn everything that I know about credit. And there's also the 850 club that I have there. It is a membership. It is only $20 a month. It is canceled anytime you want to, but it's $20 a month. You can also pay for an annual subscription and get a discount. But with that 850 club, you can learn everything that I know as far as how to repair your credit. There's some videos on there that'll teach you everything that you need to know as far as disputing with the credit bureaus, disputing with your creditors, what to look at on your credit report, so that you know what to dispute. You get 93 sample dispute letters, so that if you don't know what to do, you can find it in those 93 letters. And you get an FHA loan if you plan to use a home as a, did you say rental in the future? I think that may be what you were saying, but I'm not 100% sure, but I don't think you can use FHA for a rental loan, for a rental home, if that was what you were saying. And I know they don't want you to have more than one. I believe that's correct. They don't want you to have more than one FHA loan. So once you get approved for one, you cannot get approved for a second until you're done with the first. Assisted living facility. I'm not 100% sure. I don't think you can, but I'm not 100% sure on that. Now hold on, you guys. Actually, looks like my phone is about to die on me. I guess I should have charged up a little bit better beforehand. Hold on a second. Okay. So yeah, I almost lost you guys for a second, but we're still good. What other questions did you guys have? I hope I answered the your other questions. Did you talk about rent to own? I didn't talk about rent to own. Now, everything that we were talking about now was getting approved. It was just getting approved for a mortgage to not to a specific person. Careful of lease purchases. And could you say why, Andrea? Just to let them know. But I know you about some of the people that you can that you try to rent to own from. Um, I've heard of some bad situations come up with some other people, so you kind of just want to be careful about who you deal. Tap out.